policymakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in a moment, we'll discuss the impact of U.S. tariffs on Europe. We'll talk central banks, European banking regulation with Lorenzo Smaghi, the chairman of Société Générale. But first, the latest on the Trump administration's ongoing battle with universities. The Secretary of State, Marco Rubio, has now ordered U.S. embassies worldwide to stop scheduling interviews for student visas. Now, the move ramps up President Trump's feud with higher education, which first centered on elite schools like Harvard and Columbia over anti-Semitism. Let's get more with Rosalind Matheson, REMEA News Director. Ros, thank you for joining us. This feels like a big escalation because it goes, first of all, right to the heart of what we thought America did best, which is university. And, you know, the Trump administration just won't let go.
Well, that's right. So it's interesting to see, like, a lot of the focus had been on Harvard and Columbia and, you know, the top shelf universities, Cornell, Northwestern. This seems to be really sprawling out across that whole layer of US universities and saying, you know, of the 1 million plus foreign students who come to the US, they're now going to face even tougher vetting. I mean, the vetting is already pretty stringent, but now they're going to add this element of real scrutiny of social media onto that, and they've kept it vague enough to what does that mean? What are they looking for, and on what grounds might they rule you out? So it's again going to send that chill through the international student community. If you're thinking about your options about where to study university, does this give you further pause in terms of thinking, is there any guarantee if I get into the US, I'll be able to complete my degree in the US? And obviously it's not inexpensive to be an international full fee paying student in the US. It seems to be he's now like looking at the whole sector, and he's talking about trade schools, which is interesting. So is this about a certain tier of education in the US, a certain level of university, these venerable old institutions that are seen as elite universities, and pushing people more towards trade schools and money, he says, towards trade schools in the US? That's starting to emerge as a narrative, which is interesting. And that's much more about focusing money, as he would say, on US students in the US.
So interesting. Meanwhile, Elon Musk has also, Ross, expressed dissatisfaction with President Trump's giant tax bill, which the US House narrowly passed last week.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, doesn't decrease it, and undermines the work that the DOGE team is doing.
Rosa, I'm not sure about the relationship between Elon Musk and Donald Trump. I mean, he's not holding back.
Well, that's right. I mean, it's interesting because, of course, Trump has Musk as a key financial backer. And, you know, we're a couple of months in, but we're not that far out from the US midterm elections. And so keeping Musk on side in one way is important, but it's also for Donald Trump and for Republicans, keeping the US voters on side into the midterms is also important. So you've got those two imperatives with this bill in a way. Like, he needs these tax cuts to go through. And the question is, how much can you do on the spending side? You've got some Republicans saying that bill does not go far enough. You've got some saying, hang on, Medicaid, we're getting into territory here that's going to be difficult for us coming into the midterms. I mean, that bill's going to have a very interesting time in the Senate, to say the least. But in terms of Musk and Trump, I mean, Musk was saying you can have a big bill, a beautiful bill. You can't have both. And is he starting to show again that frustration with where his efforts on DOGE? He's saying, well, has this actually achieved anything? It's interesting that they don't talk directly about each other. You're not seeing Donald Trump really comment very much of late on social media about Elon Musk, so perhaps the relationship is cooling a little bit, but not willing to go into outright direct criticism, because in a way they both still need each other.
Ross, thank you so much. Ross Matheson there with the very latest, of course, on the U.S. administration and Elon Musk. Now, the European Union is seeking to strengthen its common market in the face of rising geopolitical tensions and a growing trade conflict with the U.S. Policymakers are also touting the euro's global role as investors retreat from the dollar. Well, joining us now is Lorenzo Smaghi. He's chairman of Société Générale and former ECB executive board member. So, Mr. Smaghi, thank you so much, as always, for giving us a little bit of your busy schedule. I want to talk about inflation. I want to talk in general about the conundrum in which central banks are now. If you were still on the ECB Governing Council, what would you do? Is there room for more cuts, or would you pause and see what happens?
I think inflation is coming down, is well anchored. Expectations are well anchored. Prospects for growth are, weakening because of these trade wars. So I think interest rates can come down. I think the decision in next week is a done deal. The issue is, will there be further cuts? I think that's an issue for the fall.
But is there a worry actually that inflation persistently undershoots 2%?
Well, we will see what the forecasts are. They will provide forecasts. I saw the Commission and others looking at 2026, 2027 going 1.7%. There is a risk at the end of this war and these tensions, will we go back to a world with excess savings like we had last decade? And in that case, you cannot leave it, happen too quickly. And let it go. You have to react quickly, and that may require some easing of monetary policy, maybe reflecting of what, central banks did wrong last time, like negative rates, which were not very efficient, and a different maybe also quantitative easing, going back. That's a big issue. But for now, I think the prospects are just, looking at the next few months. I think the next week's cut is a done deal, I think.
You're very interesting because you understand monetary policy like few people do in Europe, but you also are chairman of Société Générale, so you have data, right? You have the data of loans and what businesses are doing. Is the economy in Europe in such bad shape that interest rates need to be below 1.75%?
The economy is holding, I would say. When we look at, from our point of view, the cost of risk is still very low. So, companies are doing relatively well, but you see some slowdown. And so the economy, monetary policy has to anticipate. They cannot just look at data today or tomorrow. You have to look at, and you need to dare making forecasts. And the forecasts going forward are not that great. If, China is slowing down, or at least it's not recovering that fast, and this trade war is going to lead to weaker growth over the next couple of years. So you cannot just wait for the data to come out and show the weakening.
What worries you the most about Europe right now, or global growth? Is it trade wars, or is it just this incapacity of getting out of some structural things that Europe does? It has chances to seize the moment.
Yes.
I don't know whether this is one of them or whether it will squander it.
No, there is a demand in the rest of the world for Europe, for European assets, for European goods. It's up to Europe and to European countries largely to stand up to the challenge and continue the progress towards greater integration. Unfortunately, when you look at issues in some areas like the financial sector, you see some countries becoming more protective. And you see that in some of the banking issues. So this is a bit disappointing that we are not up to the challenge as Europeans. But I'm still confident the European Commission will try to re-energize and present some, programs for simplifying regulation, trying to improve, eliminate barriers within Europe. That's the key issue.
But so what are some of the, if you look at the ECB task force on regulatory simplification, which again is actually difficult to say, what specific issues do you want them to address?
Well, in fact, first you have to look at all regulation, overlappings, but more than it's not only about simplification. It's really, after 10 years of banking regulation, we should ask ourselves, does it make sense to have this kind of regulation? Because 10 years ago, these regulations, these Basel agreements were largely built on the post-Great Financial Crisis trauma. 10 years after, the world has changed. The non-regulated sector has grown enormously. It's a source of unknown risks. Risk management has improved. The world has changed. And I think it's time, like we used to do in monetary policy. Every 10 years, you put into question your monetary policy framework. I think there is a need for check-up also of the banking regulation. Does it make sense? And we should do this in Europe, not only looking at what the US do. We should do it just for our own interest. Does it make sense to have all this regulation about liquidity, for instance? This gold plating, these double calculations. So it's not only simplification, is really asking ourselves, the regulation we have put in place does it serve the European economy?
But how can ECB, for example, supervisors maybe lighten the burden for banks to oversee some of the activities? I mean, that's at the end of the day, one of the biggest concerns from banks.
I mean, you have the regulation and you have supervision.
Yeah.
I mean, in both areas, they have to ask themselves, are we efficient? Are we serving the economy? Are we making sure that, banks can do their job efficiently to support companies, to support households? And I think if they did that seriously, and if we do it together, actually, we can see that there are many areas where we can not only simplify, but make things more efficient. Lighten the burden that banks have in their day-to-day businesses.
What do you think of the EU delaying actually the implementation of these new bank trading rules? Is it a good decision? Was it the right thing to do? Well,
it's a good decision for the wrong reason, because we decide to delay this regulation because the Americans are delaying it. But, we should ask ourselves, this fundamental review of the trading book, does it make sense? Has anybody thought, 10 years after this Basel Agreement, does it make sense to have this kind of regulation for Europe in particular, where we need to build a capital market, where we need to have players, European players that are active in the market, and this regulation is actually penalizing in a very strange way, by the way. I think not many people really understand it. I wonder whether the regulators shouldn't give a new look at it. Right. Whether it makes sense for Europe to approve these regulations.
So even just the EU also opening its banking package, right? I know there's specific things that certain executives have said just make no sense. Is it scrapping the output floor, making phase-in period permanent? Like, is there something concretely that you would just change right now?
No,
I know there's also lighter capital treatment of some of the unrated corporates. Does that make just common sense?
There are so many things we have to look at. It's not an issue of deregulation, by the way. It's an issue of really efficiency of regulation and making the sector competitive and able to support the economy. I think giving a fresh look at each of the various areas. For instance, the Basel Agreement tried to discourage internal models. Yeah. So banks are trying to move back to standard models, but the regulator is preventing it to move back, and the supervisor is making it very difficult to go back to standards. Well, that should be welcome. It shouldn't be so complicated. So it's just the complexity of these rules that should be looked at with fresh eyes, with the idea not of deregulating, because that's not what we're asking, but to have more efficiency and to free time for commercial, for making business in the sense of lending, rather than doing compliance and regulatory stuff.
Can I ask you something about the Trump tariffs? Do you see clients choosing European banks over U.S. ones because of what's going on, or is Société Générale benefiting?
Well, I think it has been a very good period for us. Markets. I think markets are realizing that we need investment banks in Europe. It's good to have diversity, but to have banks that follow you, are close to you during this period of time is very important. So this is an opportunity for European banks to strengthen their position in Europe. And it's an opportunity for regulators to help them strengthen this position in a competitive environment where we are at a disadvantage compared to the US, who benefit from this big market that they have at home. And we don't have yet an integrated banking market in Europe. And we see how this fragmentation is playing every day with new barriers, let me not dwell too much on it, but it's a bit surprising that we say we want a single market, but then we found that savings is a national security issue, apparently. We discovered that. Reading the newspapers.
Something that you don't agree with. Mr. Bini Smaghi, thank you for joining us today. That was Lorenzo Bini Smaghi, the chairman of Société Générale. Now, coming up, we'll digest what's going on in the markets. We'll be talking to Peter Oppenheimer from Goldman Sachs. That's next, and this is Bloomberg. In NVIDIA reports earnings later today, giving the market a highly anticipated update on AI demand amidst rising trade tensions. Our Charlie Wells is here with a preview. Charlie, it's going to be a big one. What are we expecting?
Good morning, Francine. So there is so much anticipation over these earnings, given the fact that the shares of NVIDIA have been on such a journey this year. You can see sort of a double dip year to date where we had those concerns about AI and then later in April, concerns about trade. And if you're paying attention to earnings today from NVIDIA, you really want to focus in on that trade issue, how China factors into the mix here, because Trump in April banned NVIDIA from selling its H2O chips to China. Jensen Huang, the CEO, has had some fighting words about that. And that is in large part because of how important China is to the revenue of this company. Now, there have been reports that NVIDIA could be selling lower price, lower power chips to China, and that could give a boost. That is a piece of information that analysts and investors are waiting to see if they hear more about, if they hear confirmation of those reports in this earnings call. But we know that there is a lot of cash on the sidelines. There is a lot of eager anticipation here. And we know that with NVIDIA, we are seeing a potential implied post-earnings price swing of 7%. You got a lot of cash parked on the sidelines, a lot at stake here.
Certainly. Charlie, thank you so much. Charlie Wells there with the very latest on NVIDIA. And I think we're also speaking to the NVIDIA chief executive a little bit later on this evening. Now, let's get into how the markets are pricing in EU-US trade tensions after President Trump announced an extension to the EU tariff deadline. Well, with us now, Peter Oppenheimer. He's chief global equity strategist at Goldman Sachs. Peter, as always, thank you for joining us.
Thank you.
There's just a lot. There's a lot in the markets. There's a lot of volatility. They're up, they're down. It's kind of, sometimes there's appetites and there's a lot of things going on with bonds as well. What are clients generally telling you? What do they want to do with their portfolios?
Well, I think there are two questions that most investors are focused on at the moment. One is, where does the market go from here? And the other one is, what do you do in terms of asset allocation and geographical distribution? And I think on the first point, given the rally that we've seen from the low points just a few weeks ago, the risk reward is not that attractive. Valuations are back to where they were at the start of this year, even though where we're settling on tariffs is less good than people were hoping at the start of the year, and growth is slower. On the second point, I think there's growing appetite, particularly among global investors, to diversify more, to have a wider geographical spread. And that's a theme that we've been talking about for some time, given the concentration of most people's assets in dollars and dollar markets.
So you would diversify into where?
Well, I think there's different forms of diversification. Firstly, across asset classes. So we want to have a good spread across, with some actually an overweight in cash at the moment, equities and bonds as well. But within equities geographically, bear in mind at the start of this year, the US had the highest weight in the global index ever. And although that was justified given years of better earnings growth, we're starting to see more of convergence and therefore a more broad geographical spread. But I think also across sectors as well. It's not just about tech now. That was a sector that was really leading global equities for a decade and a half. And now we're starting to get a wider spread of opportunities. So we think by diversifying, investors will just get a better risk-adjusted return.
Peter, overall, I mean, there's a lot of competing forces, and I know it's also unclear where tariff ends up. So if you look at Europe, for example, are there opportunities if Europe seizes the moment, or does it look complicated just because it's in between U.S., China, and it seems that there are structural problems?
Yeah, I think there are structural problems, but they are well known about and reflected in valuations. I mean, if you look at the European equity markets, they trade with a valuation of about 14 times. That's not particularly cheap relative to its own history, but certainly very cheap relative to the US. There's a better prospect, I think, for rates to come down more quickly in Europe compared to the US. And we're also starting to see a shift in currencies. And when you look at things in a common currency basis in dollars, you're starting to get much better returns in European equities. And there are areas of growth, even in the value spaces, which were long neglected, which are looking more interesting to investors. And so I think there are selective and really interesting opportunities in Europe for global investors right now.
What are you expecting in terms of earnings per share and earnings in the next couple of quarters? And is it really different? Is it different depending on where you're headquartered? Does a UK-based company behave differently to a US one, to a German one?
Well, I think there are clearly sort of currency translation effects that are increasingly going to have an impact on earnings. Given the likely probability that the dollar continues to moderate against both sterling and the euro. But I think that we're still going to see relatively weak profit growth on both sides of the Atlantic this year, but most likely avoiding recession. And when you think about the prospects for easing monetary policy and fiscal policy at the margin across Europe and those cheaper valuations, I think that there's growing opportunities for investors who may have been neglecting it because there was so much activity happening in the US itself. And although the US market offers selectively very interesting opportunities, we think even within that market, investors should be broadening their exposure across different sectors and not focusing purely on the biggest tech stocks, which have been the dominant drivers for the last few years.
Peter, I mean, there's so much focus on private companies, right? I mean, again, the money, deploying money or, putting capital to work, you have a lot more options than you did 20 years ago. Does that complicate, actually, the equity space?
Well, in a way, it provides another opportunity for diversification because people are diversifying not just across asset classes and geographies, but across public and private markets. And I think that's a good thing because it gives people a broader set of different types of assets and different structures. And I think that private markets are going to continue to grow significantly. And the opportunities to scale and grow businesses in the private markets and keep them private for longer is clearly still very much in the fore. And I think you're seeing a growing institutionalization of those markets, which are becoming very attractive.
On tech companies, I know you mentioned it, but how is it too soon to find winners, actually? Because it seems, everything's changing very fast.
It is. I think what's happening there, again, is a broadening because the dominant tech stocks, largely in the US, had such strong competitive moats and was so dominant in terms of overall profits in that industry that it is beginning to widen out. Clearly, there's more competition coming. We've seen that in China already this year and in other places. And I think that's a good thing because it's going to accelerate adoption and take up of new technologies like AI and create the platform for new products and services to emerge that leverage off these foundational models. And I think, again, that tells us that there are good growth opportunities in the tech space, but they're likely to broaden out and provide better opportunities across a broader range of assets.
Peter, thank you so much, as always. Peter Oppenheimer there of Goldman Sachs, also author of Any Happy Returns. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump steps up the battle against Harvard, ordering the cancellation of $100 million worth of federal contracts and pausing foreign student visa applications. NVIDIA to report earnings that will give a sense of whether demand in the U.S. can outweigh restrictions on exports to China. The chief executive joins Bloomberg this evening. Plus, Stellantis names the head of its American operations, and its new chief executive, Antonio Filosa, now faces the task of turning the car maker around. Now, the head of UBS's Asia-Pacific operation says customers are increasingly turning to alternative investments as they navigate increased volatility. Well, Iqbal Khan also said he's expecting interest rates to come down, and he still sees a potential for stagflation. Well, he's been speaking exclusively to Bloomberg's David Inglis.
While risk has come down, there is a continued potential of stagflation. However, things have moved on. And I think one of the calls we made early on, and actually already coming into this year, around diversification and diversifying across geographies, currencies, sectors, has worked out really well. So diversification it is, and diversification remains a key theme for investors and for building better investment portfolios.
Yeah, and I think certainly with the facade of U.S. exceptionalism starting to go away, you are getting more portfolio flows coming out. What are you seeing as far as wealth flows are concerned, to the point you're making on needing to diversify, especially now?
Look, clients are looking at this world coming into 2025 and seeing that having a more diversified portfolio, thinking about how you allocate capital in different currencies, different sectors, but of course regionally as well. Look at the European indices, look at Hang Seng just here in Hong Kong.
Yeah.
You look at these indices, you are clearly, if you're thinking about the equity space, think about diversification, think about the bond market as much as, of course, alternatives. So fundamentally, we've been very much focused on helping our clients invest on a diversified basis, and I think that's working quite well. At the end of the day, in an environment with a lot of volatility and uncertainty, while we have a pause around tariffs at this point in time, there will be continued volatility. We expect continued volatility. And in that perspective, I think being diversified, thinking in scenarios, that is absolutely key. And that's what we're helping our clients think through, work through, and help them invest accordingly.
Is the assumption for rates still to go down?
Well, look, I think we are starting to see inflation numbers come down to some extent, right? Having said that, there clearly is a perspective of timing around rates. We do continue to expect that rates will come down. It's a question of time, and of course, as we see further data come out, and also just let's not forget the uncertainty we still have around tariffs and the environment itself. So I do feel that while we will see rates come down, it's a question of timing.
Right. And it's puzzling to us sometimes. To your point, you look at the equity benchmarks in Europe, you look at here in Hong Kong, it's as if nothing happened in April. You know, we're back to those levels before those Liberation Day announcements were made, and even more. But the bond markets seem to be dancing to a separate tune. We seem to be getting higher and higher yields on the long end. Which asset should I believe?
So look, I think what is interesting clearly is after some of the adjustments and some of the events that we saw earlier this year, even S&P is at more than 5,900, so actually higher than when we started this year. And yes, absolutely, European equity markets as well as Hang Seng are doing quite well. In the bond market, or overall long-term rates, of course, are impacted by fiscal policy and of course also what is to come, specifically in the U.S. when it comes to the U.S. budget and anything around deficit, and the overall plan that is to be implemented. I think you're seeing that impact more on the longer rate curve.
Our exclusive conversation right there with the UBS APAC President Iqbal Khan. Now, Donald Trump's efforts to remake global trade and the U.S. economy have brought uncertainty to global markets, sell-off in the dollar and turmoil to bond markets. Well, Trump's foreign policy moves have also shifted the geopolitical landscape. So how should investors and business leaders hedge against all of this? With us now, Dambisa Moyo, principal at Versaca Investments. She also serves on numerous boards, is a member of the UK House of Lords, and the author of 4 best-selling books. Dambisa, first of all, congratulations, frankly, on everything you do. But look, when you look at bonds, and you know, we've spent a lot of time over the last couple of weeks trying to figure out exactly what's priced in, what's not priced in. But also, do you worry about, first, you know, the correlation between equities and bonds, and just what, you know, treasuries mean for investment and growth?
Well, so thank you for having me. The fundamental point, I believe, is that we're in much more uncertainty than had even been anticipated. I mean, Peter, who was on here a moment ago from Goldman, was talking a lot about what's priced in and what's not priced in, and clearly there's a lot that has not been priced in. I would say the uncertainty can be broken down into 3 buckets. Government uncertainty, so things like the bill in the U.S., which we can get into more detail on in a moment. Policy uncertainty, which is what's happening with central banks. How do we forecast the reaction to this concern around stagflation, high probability of recession that has not gone away? And then, of course, there's the whole market aspect, which has to do with the fact that the dollar, which has traditionally been the reserve currency and has been the place where people think about a risk-free rate, is now competing against gold. We've seen the uptick in crypto, and obviously, as Peter said a moment ago, massive outflows into into other markets.
Yeah, Dambisa, I mean, I guess what's very different from, the other kind of crises is that this is man-made. So you could reverse some of the policies. You could, be much more careful on the deficit. So are you expecting things to settle, or are we really in the unknown?
I believe we're in the unknown for the fundamental reason that these are structural changes that President Trump is trying to effect. And I've written actually quite extensively on sort of arguing for both sides of tariffs. I fundamentally am a globalist. I believe in globalization, but I think it's important for all of us to understand what the arguments are for sort of breaking up or really challenging the status quo, challenging the global markets. That's what President Trump is trying to do. I'm not here to defend that process, but I think it's very important for us to accept that we're not going back to the sort of low interest rate world that we were in. We now have real concerns around structural concerns around growth. We have concerns now about inflation, partly from tariffs, but also real concerns about what happens in a deglobalized world. Does that mean the cost of labor goes up? What happens in terms of commodities and other inputs?
Yeah, and massive concerns, of course, on the U.S. deficit. Right?
Absolutely.
And we saw Elon Musk really speak up for the first time in the last 3 months against the president, against that bill. We've seen others, Ken Griffin of Citadel 7 months ago speaking up and saying, we should worry about the deficit.
Absolutely. Yes.
But what happens? Could it be just like a bond auction going badly in the U.S.?
Well, and it has, as we know, not too long ago. But also, it's not just the deficit, it's the debt. The debt is over 120% in the United States right now. Scott Bessant himself has spoken about concerns around not getting to some kind of a deal by August. And obviously, the Congressional Budget Office in the United States has forecasted that deficits will be at 6% still in 2035. So structurally, again, we're not solving the underlying problem. The deficits are getting bigger, even though there are some sort of a reprieve in the middle there, but it's still fundamentally still going to be 6%, which is, it's certainly nearly double the amount in the peace times over the last 50 years. So real structural change. I do worry about the deficit. I think it's being reflected partly in the bond yield moves that we've seen, obviously in Japan, in the UK as well. And I think it's those type of structural gyrations that investors have to focus on.
Stagflation, I mean, this is stuff of horrors for investors,
yes.
Central
and
bankers,
policymakers
yes. to get out of. Are the risks of stagflation rising?
Yes, absolutely. And, we've heard Jamie Dimon talk about that. The growth picture has been fundamentally problematic for some time. And we've seen, notwithstanding the revisions from the IMF over the last 48 hours for the UK, we saw that the IMF forecasts in April were for lower growth, under 3%, which, as I always say, is necessary in order to double per capita incomes in a generation. So structurally, we were already on a path of growth decline. Now we have an inflationary problem, partly because of risk of wage ticking up because of border controls, but partly because of the tariff prices that we've talked about already. But it's absolutely, we're in a world where inflation could tick up quite aggressively here, and that means obviously rate increases, which has implications for borrowers and savers, but also for investors.
But again, it's not really priced in at the moment.
Yeah.
Not a lot of concerns are priced in, and I don't know whether, for example, we worry about inflation, but it's not come through the data yet. So whether we're in a weird bubble at the moment where data will start to turn.
Yes, and so I just wrote a piece not too long ago talking about what the data is telling us. Obviously, the soft numbers I think were flashing. Certainly in consumer sentiment, even though the most recent numbers look much more constructive. The real concern was that what we're seeing in the sentiment market, but not really seen in hard data. I do think many people like myself who sit on corporate boards are looking at hard data and worried about a turn, and whether that comes from China, whether it comes from the hot wars that we're experiencing, that continue to experience around the world, it's not clear. But certainly I think that there's flashing red now in the bond markets, and that's what we're focused on.
What are boards talking about? So you have a huge disruptor, which is AI, and underlying, I imagine that it's still quite difficult to say, I want to spend, $2 billion, $100 billion here or there, given all of the uncertainty.
So fundamentally, my whole philosophy, and my board colleagues, I think, would agree on this, is let's just focus on the things we can control. Right. There is more uncertainty, but we're still managing processes, we're still managing and thinking about investment, even in these challenging environments. We're thinking about different regions, we're thinking about different products, and of course, fundamental shifts like AI are a big piece of the discussions that we're having. But also, we have to manage the business thinking about? Should we be thinking about borrowing more, borrowing less, given where bond yields are forecasted to go? How do we pass on or think about passing on the prices of higher inflation? How do we think about managing the staff and opportunities for employment globally in a very uncertain world?
You mentioned gold and also crypto moves. I mean, gold is behaving as the safe haven par excellence. Does it continue that way? And what's crypto now?
So I feel a little bit tainted here. I was actually on the board of Barrick Gold, the largest gold producer in the world, when I was on the board. And so I feel like I'm always a gold bug. But even I had not forecasted it would get to over $3,000, which is where it is today. I'm much more of a gold person than I would say of crypto for all the arguments that are known. But, even for me, seeing crypto at $108,000, certainly monitoring that as well.
Yeah, because crypto was meant to be again, I know it's policies, that there's a love inside the Trump administration for crypto.
Yes.
But it's unclear where it goes from here, right?
Yeah, absolutely. But it always has been unclear. I think there's no underlying discounted cash flow model to say, oh, this is where it should be priced. I think it's very much driven on sentiment. We're seeing that. And as I said, I joke with my husband that, several years ago we were debating, should we buy or not? It was at $3,000. And now it's at $108,000. And you think, I just can't imagine that it's gotten this high. So I think it's a wait and see thing.
Yeah, it's pretty crazy. I think Matt Miller, actually in the U.S., says he could be a billionaire, but he forgot the password. So that's another problem that some people have. Dambisa, thank you so much for joining us today. Dambisa Moyo, principal at Versaca Investments. Now, Stellantis has named Antonio Filosa as its new group chief executive to replace Carlo Tavares, who quit abruptly in December. Let's get more from Bloomberg Southern Europe managing editor Tommaso Ebhardt in Milano. Tommy, thank you. So who is Antonio Filosa? I know you've been following this very closely. Who is he and why was he picked as chief executive?
Ciao Francine, buongiorno. We talk in Italian because Antonio Filosa is Italian. He was born in Naples. He has been working for Stellantis since 1999. So we can say it's a little bit a comeback of the old guard which ran Fiat Chrysler under Chief Executive Officer Sergio Marchionne. It was Sergio Marchionne. He was Sergio Marchionne who essentially made Filosa one of the top managers. Filosa was seen in the past as what Marchionne used to call the young punks who are ready to succeed me. So somehow is a comeback of the Marchionne people running Stellantis. Clearly, it's a very difficult job. Filosa, yes, he's Italian, but was now overseeing the North American business, the most important business of Fiat Chrysler. He has been working closely with John Elkann in the last 6 months, including visit to the President of the United States of America, and he's getting a big task.
So what are his priorities and challenges? I love that, the young punks. What's this young punk's priorities?
I mean, clearly, priority number one for Stellantis remains North America. Is the region where Stellantis used to make most of its profits. So priority number one is to fix the North American business. Then obviously to lead the transition in Europe, very complicated market where we have started years ago a journey to electric vehicles, which is now facing probably some delays, and then to grow in Asia, possibly look at China. So has a lot of things to do, clearly.
Tommy, thank you, as always. Tommaso Ebhardt there with the very latest on Stellantis. Now, coming up, Ukraine calls for $30 billion to boost weapons production as President Zelensky prepares to meet the German Chancellor in Berlin. We'll have plenty more on that next, and this is Bloomberg. Bloomberg actually has learned that Ukrainian President Volodymyr Zelenskiy is set to arrive in Berlin. I'm all confused, all muddled up, to meet the German Chancellor Friedrich Merz in a few hours. Now, this comes after Donald Trump said Putin was, quote, playing with fire over his attacks on Ukraine. Well, I'm very pleased to be joined by Bloomberg's Oliver Crook, who's in Berlin, who will unpack all of this in a calm manner. So Trump's criticism of Russia is definitely growing, Ollie. Is this significant?
Yeah, so listen, I'll try to unpack it in a calm manner. I mean, I think it was significant to get that tweet, or I should say that truth from Donald Trump yesterday about Vladimir Putin. I'll quote it directly here, saying that what Vladimir Putin doesn't realize is that if it weren't for me, lots of really bad things would have already happened to Russia, and I mean really bad. He's playing with fire, and this in reference to the massive bombing campaign that the Russians have been conducting against the Ukrainians over the last few days. Some of the biggest days of bombing, really since the beginning of the war in more than 3 years, have occurred over the last few days. A number of civilians killed, and this has really upset the Trump administration and Donald Trump himself, who has been trying to bring the two sides together to a ceasefire and discussions and bringing them to the table. That, of course, does not seem to be Vladimir Putin's intention. This is what we've kept hearing repeatedly from a number of leaders of Europe, and potentially it seems that the Trump administration and Trump himself is beginning to feel that that might in fact be the case. What is now waiting in the wings is this bill that has been put forward by Lindsey Graham. It's ready to go. This would mean secondary sanctions on the Russians. This would impose sanctions effectively on third-party countries that buy oil and gas from the Russians. This would have a huge impact on restricting the flow of money to the Russian war machine. It's hard to say if we're really actually any closer to those going into force, but that is the threat that potentially is hanging over any sort of displeasure that Trump has over Putin and his conduct in this war.
So, Ollie, what can we expect from the Merz and Zelensky talks today?
Yeah, so what I think is interesting is this is really sort of the moment here for the new Chancellor Friedrich Merz to demonstrate what kind of ally he is going to be to the Ukrainians and to Zelensky. He's had a much more hawkish tone in terms of the tone he has taken versus Olaf Scholz. You know, he ran on a campaign saying that he would deliver these long-range Taurus missiles to the Ukrainians. These are very long-range missiles that the last Chancellor basically thought were too risky to give to the Ukrainians because theoretically you could strike as far as Moscow with some of these missiles. The problem is that he has not committed, Friedrich Merz, yet to actually sending these since he's taken over as Chancellor. So is that an announcement we could get a little bit later, as the two will be meeting in about an hour's time outside of the Chancellery here in Berlin? And we should remember also the important context here. We're waiting for the summer. There are a number of 50,000 troops amassing on the Russian border near Sumy. This could mean another summer offensive. We also get to a point this summer when that aid runs out from the Biden administration, that old set of aid, and that the Ukrainians are going to be looking for more military equipment. That is why they're now asking for $30 billion in order to boost up their own industries. That's the latest reporting in those comments that we had from Zelensky yesterday. So it's really a critical moment, and any sort of support that we're going to get for Ukraine is not going to come from the United States. It might come from Germany. This is the place that is now going to devote $60 billion to their military this year. They've removed the debt brake, and really Friedrich Merz, as a top priority, has said Germany is going to be a military industrial powerhouse.
So, Ollie, very quickly, I know you mentioned, well, we could find out today whether Germany will send Taurus missiles, but it does seem that, the relationship between countries and some of the missiles they send is very different from European country to European country.
Yeah, and it was made really complicated over the last few days from Friedrich Merz, who basically said that there was no limits on striking within Russia from Germany. Remember, Germany was one of the holdouts. The UK and the US have said it's okay to strike within Russia as long as you're taking on military targets. Then a few days later, he sort of walked it back a little bit and created a great deal of confusion. And there was criticism even within his own party saying that basically you need to take a clear line on this because it makes it look confused. It makes the European position look muddled. We need clarity, not confusion, because it makes the Europeans look weak to Vladimir Putin. So maybe we get some of that clarity a little bit later today.
Ollie, thank you so much. Oliver Crook there with the very latest, of course, on Merz and Zelensky. Now, super long Japanese yields jumped after an auction of 40-year sovereign bonds met the weakest demand since July, adding pressure on the government to reduce issuance. Well, let's take a closer look at that bond story with Bloomberg's Rachel Evans. So, Rachel, thank you so much for joining us. I mean, it's a massive, massive week in terms of bonds. What did we find out after yesterday's move in JGBs?
Yeah, well, I think we found out from the auction today that move was perhaps a little optimistic, that we would kind of be seeing the rally continue. We saw a poor auction of 40-year debt today, as you noted, and that's following on from the poor auction of 20-year debt last week. So that tells you that there's still this kind of mismatch between sort of supply of bonds in Japan and demand for those bonds. It's something that obviously, yesterday we were talking about kind of how the Japanese are looking to sort of try and reset, the kind of bond issuance mix to sort of address that, and they put out that questionnaire asking for feedback, and that's what prompted yesterday's rally. So I think that's kind of in the background, but clearly that sort of potential change in the future was not enough to convince people that they want to be in Japanese bonds today.
So, yesterday's global bond rally, just a brief pause, basically, in all of this repricing.
That's what it looks like, yeah. I mean, it certainly seems like the volatility is going to continue. I mean, when you look at kind of the events on the horizon, next year we have kind of sales of 10-year and 30-year Japanese debt. So another opportunity for investors to potentially sit on the sidelines. And as we head kind of further into June, we have a Bank of Japan meeting. Obviously, the Bank of Japan kind of tapering its bond purchases has been one of the causes of this kind of oversupply, if you will. So potentially what they say about kind of the pace of that tapering could also impact kind of appetite. And I think when you kind of overlay the fact that we also have US auctions, big ones kind of coming middle of June as well, 10-year, 30-year debt, testing kind of that broader global appetite for long-term bonds, things could stay pretty volatile.
Rachel, I mean, what do you look for in the last, next couple of days? There's, of course, ECB. It feels like a done deal. Are there any other, interesting points that you would look at? I was struck by the fact that Elon Musk was really against the big, beautiful bill that Trump was touting because of concerns about debt in the U.S.
Yeah, I mean, that's a really interesting narrative because that doesn't go away anytime soon. If you're thinking about what are the kind of sort of drags on US bonds and what will prevent, a rally from picking up steam, concerns over the fiscal picture for the US are definitely a very big part of that. And I think now we've seen kind of the US being kind of downgraded, sort of losing its kind of sort of last, of the top three for a AAA rating. I mean, that kind of is very much front of mind for investors. So it was interesting kind of, some of the commentary yesterday about this sort of questionnaire from Japan centered around whether the bond vigilantes had actually won in terms of getting the Japanese to think about this. And I think that's going to be a question now on the US side. Do the bond vigilantes up their game and start trying to push back against this bill and sort of agree with Musk that it's not actually that beautiful?
So in what kind of timeline? I mean, do we know, or could it flare up really at any moment?
I think it can flare up at any moment. The market's very fickle. It tends to kind of latch onto a narrative and that kind of gathers steam. At the moment, there's not kind of a huge sort of narrative around the US. It's been more focused on Japan. But as that kind of sort of changes, in the absence of any other news, you could see that kind of pick up. So I think, over the next kind of sort of couple of days, maybe, but certainly as we head into kind of like the middle of June with those US auctions, as I mentioned, that becomes another sort of focal point for people to kind of see whether there's a foreign buyer strike.
Rachel, is there anything else when it comes to UK gilts or anything else that we should be watching out for, maybe more locally?
I think, you mentioned the ECB on the European side. That's obviously going to be a big sort of thing for people to be watching next week. Widely predicted to kind of have a cut that's pretty much priced in. So I think that's pretty much baked into the market. On the UK side, there's a lot of kind of the political commentary around some of the domestic politics. Is this kind of two-child cap scrapped? Or is the winter fuel payment back? And that has a really big impact on the fiscal headroom that Rachel Reeves has and how bond investors then view kind of the UK's integrity and its fiscal responsibility. So I think that will be something to watch as well.
Rachel, thank you so much. Rachel Evans there with the very latest, of course, on the bond markets. Now, don't miss Bloomberg Technology's special coverage of those NVIDIA earnings. We'll get, of course, reaction to the numbers from the chief executive, Jensen Huang, as well as investors and analysts. That's at 11:30 p.m. UK time. Up next, Bloomberg Brief, and this is Bloomberg.